Good morning, good afternoon, and good evening. This is Keesa Schreane. Social considerations in sustainable investing are often dismissed as less of a priority because of the belief that they present a lower risk to revenue streams or are less likely to be subject to regulatory action or punitive measures. Now, companies and organizations are beginning to partner, working to change the tide of this perception and provide not only more transparency in their own disclosures, but also challenging others to do so. Joining us today to discuss this, we're very grateful to have Global Head of Sustainability and Impact at Goldman Sachs, Margaret Anadu. Thank you, Margaret, for joining us.
Hi, thanks so much for having me. So excited to be here.
Great. So, Margaret, jumping into it, what role does an ESG investing asset manager have in creating a more sustainable and inclusive society?
Sure, a very important role. So just to kind of set the table, here at Goldman Sachs, we think about sustainability and impact in two key pillars. So climate transition and inclusive growth. And we view these as central issues for markets, for economies, and most importantly, fundamental to individuals and families overcoming systemic obstacles on their path to creating a better future. And so to your question on the role that asset managers and ESG investing specifically has to play, the reality is there's not enough public funding, taxpayer dollars, or philanthropic capital to really address today's pressing challenges. Investors and managers of private capital simply have to be a part of the solution. And so it's my experience, and certainly the experience we've had here at the firm, that the most scalable, the most impactful solutions are often the result of certainly market-driven investing activity, but really in partnership with the public sector, with philanthropists. And so on the investing side, we view climate transition and inclusive growth as key drivers, not just of managing risk, but equally opportunity. And so on the risk side, we are moving toward integrating environmental and social considerations into all of our investment decisions, not just those that are part of an explicit environmental or social strategy. And it's our view that these factors, they're what all prudent investors should be considering alongside traditionally considered risks. And so this will reward companies that are forward thinking about their impact, and it'll slow capital flows to companies which pose the greatest risks. We believe strongly that companies that are focused on climate transition, that have a plan to decarbonize, that are not just aware, but prepared for the significant regulatory change that we view as imminent, are simply better run companies, and that we will be more profitable in the long run. And so similarly, companies thinking about inclusive growth with diverse management teams that bring the best ideas to the table from all corners and treat their employees well and think very thoughtfully about the impact of their products and services on society are also simply better run and are going to be better positioned to weather the downside risk that we believe is inherent in strategies that aren't forward thinking, that don't think about climate, and are not responsive to what we see as increasingly broad stakeholder focus on social issues are important to owners of companies, employees of companies, consumers of companies, and so that risk is material. And then on the opportunity side, right, just one. And we provide capital to solutions addressing climate transition and advancing inclusive growth, right? So the first piece I mentioned is about making sure that all of our investments take those things into account. But on the other side, we can also find companies that are, providing solutions around clean energy. We think that's a really particularly compelling investment strategy. And so we've launched investment strategies on the public side of our business, in our private markets business, focused on that thesis. And, we're bullish on things like workforce housing, given, most of new multifamily production is higher end and fails to address the shortage of quality housing affordable to low and moderate income families. So we created a specific bespoke strategy around this. And more broadly in real estate, we see lots of opportunities. We're driving efficiencies in our investments by incorporating best practices. We're piloting innovations around sustainability and inclusive growth. I'll give you just a couple of examples. right? When we're implementing energy efficiency retrofits and green construction practices across our entire real estate portfolio, that's going to lower operating costs. That's going to reduce our carbon footprint. That's, of course, better for the environment, but it's also increases our returns. And then
So,
things
Margaret,
on the
in that
social
example,
side, like we're now providing tenants.
yeah, in that example specifically, I'd love to get an understanding of how these groups are working together. So it sounds like partnerships really, that's underpinning a lot of what you're talking about. So if we're looking at the asset managers and if we're looking at the philanthropic funding and other public funding, I'm looking at all those as partnering together. How do those various entities work together via a partnership?
It happens in many ways. I'll give you an example of something we're doing in financial health in our U.S. multifamily business. So there was a not-for-profit that we made a grant to. This is probably 3 or 4 years ago, when we were trying to think through innovative strategies to drive the financial health of tenants across our portfolios. And we made a grant. They did a bunch of very, very incredible pilot work and really came to this view that a very simple innovation that could occur would be allowing renters in households to report their credit to the credit bureaus. Now, it seems very simple, but if you're a homeowner, you're developing your credit every single month when you make that mortgage payment. And yet we have millions of households across the US that are renters paying their rent on time every month, and they don't get that benefit of having it really build their credit and demonstrate them as someone who can do that every month. So what started as an idea with a not-for-profit then actually helped us source a for-profit company called Asusu. They view their work as not just driving financial health for tenants, but also being part of closing the racial wealth gap, because Black families in the U.S. have the lowest home ownership rate, and that can be a vicious cycle. If you're a renter not building your credit, then you're also not going to be, more easily on the path to home ownership. And so we then partnered with this for-profit company, right? Developed this partnership with Asusu to then roll it out across our entire U.S. multifamily business. So this is, dozens of thousands of units. And what we found, similar to our broader thesis around, impact and driving returns, not only are these tenants building their credit and becoming, able to access other capital in their lives, but they're also more likely to pay their rent on time, which is a benefit to our landlords, and again, is helping drive returns. So that's an idea that started with philanthropy, drove an incredible partnership, and now has a clear social impact outcome that is also driving returns.
Thank you for that. I'm wondering, I would love to get your thought on how the sustainable investing landscape has evolved over the last, say, decade or so. The partnerships that you're describing now, are they new? Are we in the nascent stage at this point? Or do you feel that we've come quite a long way over the past several years?
Oh, I think we've come a long, long way. So I started in sustainable investing 15 years ago, and I would say at the time it was a niche area of interest. So even the language that we're using today, ESG, impact investing, sustainable investing, they weren't even mainstream. And what we saw, call it 10, 15 years ago, was that the majority of sustainability related investing were largely driven by what we call, values-based exclusionary investing. So being able to say, in my portfolio, I don't want private prisons. I don't want, companies that are developing controversial weapons. And so really it was about saying, okay, let me take out all these things that I don't like. And over the following, call it 10, 15 years, we saw a transition from this negative screening exercise to much more advanced thinking around from just values-based risk mitigation to ESG integration across a much broader set of investments. So instead of saying, hey, I don't like these 5 companies, when I look at the thousands of companies that might be in my portfolio, who are they managed by? What does the governance look like? What's the carbon footprint of these companies? And so we call that ESG integration, really looking at these environmental, social, and governance factors across all of the investing activity. And I would say the next set is going to be increasingly more ESG integration, but also what we're seeing is proactive investment strategies, which are seeking to drive positive change without compromising on returns. And so in today's landscape, we're seeing increasingly sophisticated asset owners and a robust convergence, and I don't even call it a harmonization of these approaches, where really thoughtful asset managers who have an approach here, they're doing all of those things. They're letting their investors and LPs figure out a way to not invest in the things that they don't like, right? Almost like a do no harm strategy. They're being very clear and data driven about how they're incorporating these factors across everything they do. And then you have the spectrum all the way at the end. How can I invest to very specifically enable, enhance, and move forward strategies that are going to make a difference and really influence climate transition and again, all the areas around inclusive growth. And so even just taking the example of, the trajectory within the Urban Investment Group, this was a business we started 20 years ago. I joined in 2005. I was honored to take the helm in 2014. 20 years ago, we were just investing equity and really just in housing. And if you look at where we are today, we still have that very deep place-based neighborhood approach, but we're up and down the capital stack, we're lending, we're investing in tax credits, and opposed to just housing, we're focused on healthcare, we're focused on education, we're focused on entrepreneurship. So what we're also seeing is really a deepening of approaches from a financial product perspective, and also a real broadening in the impacts that people believe that they can achieve. And I think that we have a long way to go there. And quite frankly, I'm just really excited about the growth and trajectory we're seeing.
So you gave us an overview of where we've come from. Would be curious to get your thought on what the next maybe 2 to 5 years looks like. Specifically, if we look at both the debt market and the equity market, we're seeing a lot more sustainability funds, green bonds, etc. Do you see the debt area perhaps overshadowing in some way? Do you see there being a lot more activity, or do you see the equities as really continuing to lead the charge there?
It's interesting. I think we're definitely seeing kind of broadening and evolution across, equity and debt. I'll comment on the equity side, and this has obviously been a big topic in the news even recently. The idea of stewardship and engagement as equity owners. So you see it certainly from our firm here at Goldman. We take our ownership of public equities very seriously, and so we have a stewardship policy that we update at least annually, and that was actually one of the places we were able to engage really directly and proactively around some of our inclusive growth strategies. So we started, this was 3 years ago, we used our vote to say, look, we're going to vote against the nominating chair for boards that did not have at least one woman, one diverse member on the board. We advanced that a year later to say, we're actually going to vote against the entire nominating committee if we don't see the diversity that we want to see on the board. And just this year, we said, we're going to vote against the entire board. And right, when you think about the scale of that activity, right, we're voting on, last year we voted on 12,000 management items. That's a real stake. And so that's something that we're seeing mostly in the equity market. But your comment on debt, we're also seeing engagement there as well. It doesn't look like the same voting and ownership, but when we're holding the debt of these companies, we're also making it clear our views on diversity, our views on policies around sustainability. And so I think you'll only see that grow in both the equity and debt markets. I think more broadly in terms of what we're seeing as we look ahead, we're just going to continue to see greater refinement in approaches to sustainable investment. And I think one of the key pieces there is on robust measurement and reporting framework. So, just like we've seen in the public markets, you have data providers like MSCI, you have Sustainalytics. We're also going to start to see that be really robust in the private markets. Now it's more complicated. The companies are smaller. They don't have the overlying regulatory frameworks in terms of what they have to report. But we're still going to see an evolution there. And for example, I expect ESG risk factors like carbon pricing will eventually be embedded into business models. People are going to have a very clear quantitative view of the impact in companies, and I think we're going to have ESG KPIs measured and managed in a way similar to other operating metrics like that's EBITDA, IRR. It's going to be just as important and really front and center. And I think as these approaches develop, I expect we will see more and more LPs assessing and benchmarking investments on their ESG credentials as well as the economic performance. But I think to get there, and this is so key, and we've really been focused on this here at Goldman, the standardization across data sources is key. I mean, we fundamentally have to be speaking the same language, and there are so many different data providers, so many different approaches, and I think at some point we're really going to have to start to coalesce. And then I think in terms of just sort of the private data providers, the other piece that's really key here is, of course, the regulatory frameworks. You know, we've all seen the real acceleration of this in Europe in terms of regulations like SFDR and, you know, Article 8 versus Article 9 funds, and being very clear about what exactly asset managers can say when they talk about a green bond or, you know, an ESG equity fund. And, you know, we've seen the comments here in the US from the SEC. So we're certainly in the US, we're certainly behind where Europe is, but I think we're all watching those trends escalate. And I think it's going to be really good for the field.
And to dive deeper into an initiative that Goldman Sachs specifically has, we know that you recently announced a new racial equity initiative, 1 million Black women. Tell us about what this means for Goldman Sachs going forward, even from a leadership perspective. How do you expect to lead the market with this type of initiative?
We're so excited about this. So yes. So back in March, we announced an initiative called 1 Million Black Women, and it is a $10 billion investment strategy alongside $100 million of philanthropy to narrow opportunity gaps for at least 1 million Black women over the next decade. And, you know, we announced that initiative just recently, but I think what's really exciting about it, certainly for me personally, is it really builds on work that we've been doing for a long time. So I talked a little bit about, you know, the Urban Investment Group. We've been investing in Black communities with really key and very impact-focused metrics for 20 years now. Similarly, from a firm-wide level, we've had large-scale economic development initiatives like 10,000 small businesses here in the US, 10,000 women internationally, all with a focus of saying we have these big pressing challenges, right? In 10,000 women, we were focused on, you know, global GDP growth, and we viewed, you know, investing in women entrepreneurs specifically in emerging countries as a really smart way to do that. 10,000 small businesses, right? That really started right after the last financial crisis, when we knew that small businesses were going to have to be a key part of the job creation that was needed in that recovery. And so similarly, in this moment today, as we think about racial equity, as we think about building back better out of this pandemic, you know, we said this is a population, Black women in the US, that we can invest in, that we can resource fairly, and they're not only going to make a difference for, you know, themselves, their families, their communities, their business, but we think the economy as a whole. And so there's a long history of investing in economic mobility and being very targeted. And so really this is just an evolution of that work. And so I think the leadership here, and look, I've heard this from our partners, our peers, certainly our clients, that it also is a moment to have a large, you know, Wall Street entity talking boldly and proudly about Black women. Certainly for me personally, you know, I take a lot of pride in that. I feel this is, you know, quite frankly, some of the best work we're doing and that we've ever done. But I also know, you know, 10 billion is a big number. 10 years is a long time. And we have a lot of work to do, and we're just getting started.
And speaking more of behind the work, you mentioned that this initiative really focuses. It's focused in a multifaceted way, and that in the past there's been a focus on small business, GDP, and emerging countries. How does a firm make that approach? How do you decide to take the multifaceted approach as opposed to going deep in a specific area? What's behind the strategy building there? It's a great question, and it was certainly the topic of many healthy debates. But I would say first and foremost, we started with the data. So
we released a piece of research called Black Womenomics back in March. And what we did there was we explored the racial wealth gap between Black women and white men in the US today, which stands, just to give you a sense of the severity, Black women in the US in 2019 had a net worth of just $7,000. That's everything they own: house, car, savings, everything, relative to white men at $92,000. And when you explore the causes of that, the foundation, of course, these are complicated systemic issues, but you can break it down almost quantitatively into a set of factors. And what we found was every single factor that is key to building economic prosperity, building economic wealth in this country, Black women have either the highest level of disadvantage or a close second. And that's in housing, that's in education, that's in access to capital, that's in healthcare, that's in financial health. And so as we thought about going deep in one area, we stepped back and, we had a lot of very, very important advisory council members guide us on this. Darren Walker, head of the Ford Foundation, told myself and a colleague, my partner in crime on this, Dina Powell, do the hard work, right? If we really want to make a difference and, be comprehensive across all of these issues, we just have to do the hard work. And what we also found is these issues aren't isolated. Another one of our advisory council members, Melissa Bradley, said, what good is it if I can get a small business loan if I can't get a COVID vaccine in my community, right? It's an extreme example, but we know that to really impact and resource and unlock the full potential of Black women in the way that we want to, all of these aspects of their lives matter. Where they can access childcare, how they can advance their education, how they get access to capital, not just to start a business, but to buy a home, how they get the appropriate information to make the right decisions around retirement and savings. And so we definitely have taken the harder path, but we also feel like the benefits are going to be greater, that across these issues, there's a compounding impact. And so as we think about really impacting Black women in all of these areas, we think the impact is going to be far greater than if we had just tried to tackle one of these issues in isolation.
Great information, so much so that it just blew my headphones away here. So I just went ahead and took those off. Wow, amazing information, Margaret. First of all, climate issues, inclusive growth, important to your firm, your role specifically, and something that you all are looking to build on at Goldman Sachs. Asset managers must be involved. Partnerships with philanthropic organizations are key, as well as the AM's piece, really key to addressing solutions moving forward. Integrating environment as well as social considerations are key to driving change from a social impact perspective. In terms of equity markets, we see stewardship really taking the lead here, voting on views, voting on values in terms of sustainability and diversity. Also, another piece we expect to see refinement of measurement and reporting. I know that that's a broad area that we're hopeful to get on the same page on, if you will, in terms of the measurement and reporting. Standardization across data and data sources is going to be key in driving these changes, and also regulatory frameworks in the US and globally is going to continue to be important. Love your answer to how you came across this specific initiative in terms of 1 million Black women. You came across this initiative and the strategy to deliver this by simply looking at the numbers, looking at the data, and a commitment to unlocking resources for Black women with access to capital in all areas of life, starting a business, but understanding the importance of capital in all areas of life. Margaret, such a wonderful, incredible conversation. Thank you so much for your time.
Thank you.
And thank you to our audience as always. And if you enjoyed today's episode as much as I did, because I loved it, please read the latest report, Amplifying the S in ESG, from the ESG Working Group, a new partnership between the Thomson Reuters Foundation, Refinitiv, the International Sustainable Finance Center, White & Case, EcoAge, the Mekong Club, and the Principles for Responsible Investment, or PRI. You can download it by using the link in the comments or scanning the QR code on your screen right now. Thank you so much for joining, and be well.